Hi, this is Tom Johnston with TomJohnston.org, and this is the first video in our series talking about investing, and we're going to keep it quite simple today. And basically I have a real simple message to you, which is start investing now. Unless you have credit card debt. If you have credit card debt, get that paid off first. Once you are out of credit card debt, start investing now. Even if you don't have a lot of money. Why? Because investing is a skill that is learned over time. And specifically, it's an intellectual skill in the sense of understanding calculations, understanding valuations, etc. But it's also equally, if not more importantly, a psychological skill. Because by its very nature, investing means taking on a certain degree of risk. And most people are not by nature inclined to take on this risk. It makes them very uncomfortable, especially if you don't have a lot of money. Even putting $100 or $200 at risk is kind of nerve-wracking. And the only way you get good at this is by doing it. It's so true in so many aspects of life. You have to practice. You have to not just practice, but actually do it to gain skills and really learn what you're doing and be comfortable with what you're doing. So as long as you don't have credit card debt, no matter what phase of life you're in, I would suggest you start investing. There's a couple of different ways to do this. It could be real estate. We're not going to focus on that today. What I love and have always loved is investing in stocks, usually through broad-based index funds. I think it's generally agreed that almost all people are much better off investing for the long haul, not trying to time the market, and not even trying to pick individual stocks, and just getting something broad-based. We can get into specifics another day, but for now, I'm just going to leave you with, you're going to want to get an index fund or an ETF. That probably, again, this really depends on your situation, and this is just general information. Before you do anything, you should be talking to somebody like a financial advisor if you don't feel comfortable with the steps you're taking. But with that proviso, you're looking at something like an ETF or an index fund where you just get your feet wet. Now, honestly, if you don't have a lot of money, if you're investing less than, say, $10,000, you may be getting charged some sort of account maintenance fee of like $30 a year, $30, $50 a year. I would say go ahead and do it. Frankly, if you're investing $500 and you're getting charged $30 a year, that's actually pretty bad from an investment point of view because you're getting a little less than 10% of every year is getting sucked away in fees. That's bad news, but honestly, you want to look at this at this point as the cost of education. $30 is nothing. The firm that I always recommend to basically anybody, at least in the United States, is Vanguard. You can get started with them for very little money. You're going to want to think about something like a Roth IRA or a traditional IRA. We'll have videos about that coming in the near future, so by the time you see this, there'll probably be a video up for it, and I'll link to it at that point. But those types of IRAs are basically tax-sheltered accounts, and with the Roth IRA in particular, you're not actually putting any, you can always get the principal that you put in there out without any penalties. So look, it's time to get started. The sooner the better, no matter what phase of life you're in. It's actually incredibly fun and satisfying. If you think about it, one traditional definition of investing is foregoing present consumption for greater consumption down the road. You're foregoing spending that $200, $2,000, $200,000, how much you're comfortable with, and letting it grow so that down the road that can eventually throw off so much cash that you can live off of it, or you use it to pay for your children's college education, or you just use it in your own retirement. And it's a very, very powerful thing. You're planting seeds, nurturing them, letting them flourish, and coming out much more prosperous than had you just blown that money in the short term. So take your baby steps. Don't do anything until you're comfortable with it. But get a little bit of money at risk. Start getting comfortable with the ups and downs of the markets. You really have to be comfortable with the idea that things are going to go down, that you're going to have bear markets. I honestly think most of us don't become solid investors till we've been through 2 full market cycles. By that I mean 2 full bear markets. That's usually going to take maybe 15 years, something like that, where you can really see how you react psychologically through a full market cycle a couple of times. You'll get much more comfortable with what you're doing, understanding these dynamics, and eventually you'll become extremely good at this. And if you build up enough assets, managing those assets are a job that pays better than most any kind of paid work, and usually don't take nearly the time. So this is it. Welcome to that initial step of investing. I'm really looking forward to getting to know you more as we walk this road together of managing our careers, learning how to save, and learning how to invest. So again, my name is Tom Johnston with TomJohnston.org. If you liked this video, please do give me a thumbs up. It helps the video reach more people on YouTube. If you want to get more videos, go ahead and subscribe. Just reach down there below and subscribe. And I will see you in the near future. And thank you so much for your attention.